Good afternoon, everyone. Thank you so much for joining in today. As you may already know, the Startup India initiative was launched today, 8 years ago in 2016. And what strides we've made in the last 8 years. We've moved from 400 startups in 2016 to over 1,17,000 startups today, really making this a country of job creators from a country of job seekers. This initiative, when it was launched in 2016 by Honorable Prime Minister Shri Narendra Modi ji, was a clarion call to all the innovators, entrepreneurs, and thinkers of the nation to lead from the front and lead India to a sustainable economic growth. I think we have miles to go, but we have pretty much achieved the goal that was set for us by Honorable Prime Minister. On the 16th of January 2016, the National Action Plan on Startup was also launched. And there were 19 action points that were categorized under three pillars here: simplification and handholding. This comprised of easing compliances, easing exits, legal support, fast tracking of patent applications, and to have a website to reduce information asymmetry. The second pillar was on funding and incentive, which was to provide more avenues for funding opportunities for Indian startups. And the last was to have a closer relationship, a partnership, if you may, between the incubation and the industry academia, and have partnerships with them so that there is enough mentoring for startups. One of the most important pillars of this was simplification and handholding, and that's where our guest speaker today, Meyyappan, comes in. He is a partner at Trilegal and has graduated with a renowned and well-known scholarship from Cambridge University. He does a mix of transaction, advisory, policy, and litigation work, and has advised several top technology, e-commerce, crypto, NFT, fintech, online media, and other companies. The list goes on, so I have to sort of keep it short. And he's provided expert opinions before foreign courts on digital tax issues and published academic articles and book chapters on taxation of digital economy, impact investment, and bitcoins. He also advises on tax aspects of mergers and acquisitions, investment fund, and private wealth matters. He's done extensive work advising and acting as the lead transaction counsel for biggest non-profit charities on complex impact bonds for impact investment funds, advised in relation to India's first USD 1 billion education outcome fund, first loss guarantees, climate finance, social stock exchange listings, and advised on blended finance structures covering CSR, ESG, and FCRA aspects. He was awarded the International Bar Association Tax Committee Scholarship in 2018 and regularly speaks at the IBA conferences. He was also the National Reporter for India as part of the IBA's National Reporter Program and was member of the Technical Committee of the International Fiscal Association India branch. Uh, we thought we'll bring in Mayappan here to talk to us more about the tax benefits that are available to startups and really dwell on what is the importance of corporate governance as startups go on in their journey. Thank you, Mayappan, for joining us today.
Thanks, Ragini. It's a pleasure to be here.
So let me set the stage by asking you some basic questions, which I think everybody in the startup community wants to learn more about. What are really the tax benefits that are offered to startups under the initiative?
Sure. So I think there's a couple of things to cover. It's a kind of complex regime for somebody who's new to it. So I'm just going to highlight a few things that come to the top of my mind. I think when we talk about and there are some benefits which are still available. Some may have been sunset over the last few years. So, for example, the if you had sold your residential property and you put the capital gains from the sale of such property into a startup, you used to be able to get the capital gains benefit on that and not pay taxes on it. But that has been sunset as of 2022. But if you see, the key benefit that is still there is that for within a 10-year period from when the startup is incorporated, either as a company or a LLP specifically, right? You get to get 100% deduction you can claim 100% deduction and basically won't have to pay any taxes on that income for any 3 consecutive years within that 10-year window. You can pick and choose. And the normal startup, I mean, life cycle is that maybe the first few years are, losses, etc. And you can always carry forward that and set off. And that's something we'll be talking about later, about how you can do that in a very optimal way. But later years, if you start making some profits, you can ideally claim this benefit during that window and try to offset any taxes that you'll have to pay. Now, one thing to note though is that while this benefit is still there, it is as of now for startups that are registered or incorporated before 1st April 2024. Now that has been extended every budget and extended by a year. So maybe we could expect that to continue this year as well. But as of now, by 1st April 2024, if you're not incorporated, you may not be able to claim that. Secondly, this benefit is applicable clearly to private limited companies and LLPs and not for partnerships. That's just how the law is drafted. And but in any case, most entrepreneurs should be set up as a public limited company or as an LLP because of the advantage of limited liability. Otherwise, as a partnership, you are exposed to the entirety of your personal assets in case there is a claim against the entity. So it's still the most beneficial one that we have currently. Um, Another thing to note is, even if you claim this deduction and you don't have any, you claim 100% deduction, and from a tax perspective, there is no taxable income, you still have to keep in mind that minimum alternate tax could still apply, and that you may have to pay 15% tax on your book profit that is there on your books of accounts. So that's sort of where we are currently. Few other benefits are the 22% regime, and I know there are probably some questions around that as well. So a beneficial regime was introduced where you can opt for a flat 22% tax rate instead of the standard corporate tax rate. But in exchange, you won't be able to claim many of the special deductions that the Income Tax Act provides, which also includes this particular one I was just referring to. So, which is that in 10 years window, you can claim within any 3 years 100% tax deduction. That benefit, so you'll have to choose either between the 22%, the new tax regime, or whether you want to go under the old tax regime and claim this benefit at a later point in time. Of course, for manufacturing companies, new manufacturing companies, it's 15%, and otherwise it's 25% for old manufacturing companies. There is also a question that comes up sometimes on, in 2016, there was this concept of a fund of funds for startups that was announced and introduced in the provisions. But for some reason, the notification is still pending, which means that if you get any capital gains and if you invest that money into this fund of funds, then you get the capital gains exemption. While the fund exists today, any contribution has not been notified under the act as a tax exempt sort of contribution. So, and there is even a high court ruling which says that, considering that provision has not been finally notified, you cannot claim that tax benefit. So that's something that we should be careful around when we do that. So let me pause there and see if there are any other questions.
Thank you so much. I think you've highlighted the most important benefit that startups have today, the tax holiday for 3 years period. I think the startup community would also like to understand there's a lot of chatter always about employee stock option plan. And it's seen as one of the biggest incentives for anybody to participate in the startup ecosystem growth journey. I think it will be useful for all of us to also understand what is the taxation regime for ESOPs currently in India, and what really should startup founders be mindful of during issuing of ESOPs.
Sure. So ESOPs is very popular way of incentivizing employees, and it's a big component of retaining them over the long run as well. And traditionally, the way the tax works for ESOPs is that the employee has to undertake certain activities for the company and over a period of time the right to that ESOP or the share in the company vests. And after the date of vesting, the employee can exercise that right to acquire the share either for zero consideration or for a pre agreed strike price. And it's in the year in which the exercise happens. The Basically, if the share value is, let's say, 100 rupees, and I'm getting it, I'm only paying 10 rupees, so I'm getting 90 rupees as a benefit as an employee. So that benefit is normally taxable as salary income. And when anybody pays, when a startup pays salaries to an employee, you have to withhold taxes on that. And this used to be a pain point because, as an employee at that point in time, I have received a share for 10 rupees. But if I have to pay taxes on 100 rupees of salary, so I don't have the cash for that. So, to solve for this problem and to incentivize startups and to help them, what the provisions were have been amended to say is that you'll have to deduct TDS, or the employee has to pay taxes within one of these following windows, which is 14 days from, so for example, if in, let's say, in year one, I as an employee have exercised my right and I have received shares. So 4 years from that date, within if 4 years from that date is when the TDS should be done. 14 days from, the 4 years from that date. Now, if I have received the shares, but in the subsequent year I have sold it, then I have received some money. So then, in that case, 14 days from the date of the share sale, you'll have to do the TDS. The third thing is, what the provision says is, if, let's say, I have received the shares, I have exercised the right, I have received the shares in year one. In year two or year three, I quit the company. So 14 days again from the date of the employee quitting, the TDS has to be done. So this is how the a longer timeline has been given for these two or three different scenarios for startups to, delay the time at which you are deducting TDS when ESOPs are exercised by employees.
Great. And could you just dwell a little bit more on how the deferring of taxation has really helped startups and employees? What is the benefit that they've really got out of this?
Yeah, sure. So there are two benefits. One is, of course, the timing delay means that there is a higher chance of, in fact, in two of the situations, there is just a delay within which there is a higher chance the employee actually has the cash to pay the tax amount. And also for the companies, it's a deferred expense across multiple years, so you're not going out of hand on day one, right? You are using this. If companies had cash, they would be giving cash bonus as salaries. Instead, you're giving a different form of incentive, which is non-cash incentive, which appreciates in value over many years. And because of these provisions, it's extended up to 3-4 years, even if there is no exercise. And as far as the second situation is concerned, where an employee actually sells it, you will have the cash to kind of pay off the taxes at that point as well. So the timing is very convenient, both from a employee perspective and from a employer perspective. And overall, it's a win-win. The company can do a lot more with that cash in the meantime during that 4-year window, instead of paying it out as taxes, which is a substantial amount on the value of the shares that is being vested with the employees every year basis.
Right, right. Thank you so much for that. I think this is a good point to also perhaps mention how can startups carry forward the paying taxes, and how can they really carry forward losses? Is there a provision that allows them and enables them to do that too?
Yes. So losses, so all companies can carry forward losses for up to 7-8 years, right? The same thing applies to startups as well. Now, one limitation that applies to other companies is that, and where the law is coming at from this, is that if, let's say, 10 people were shareholders in a company and they incurred a loss while operating the company, it shouldn't be that all 10 of them quit the company, they sell it to some third party, and there is loss harvesting by a third party who did not incur the loss. that will become a perverse incentive that will distort the market, because people will make artificial loss making companies and sell it to a profitable person to kind of offset that, right? So to prevent that, what the limitation in the Income Tax Act is that if there is a change in shareholding, at least 51% of the shareholders on the date when the company claims the loss at a future date will be the same as at the time when the loss was incurred, which basically means if today there are 10 shareholders and you have incurred 100 rupee loss, 5 year down the line, if you are claiming that 100 rupees as a carry forward and accumulated loss, then those 10 shareholders who were there when the 100 rupees was claimed, was incurred as a loss, they should hold at least 51% in year 5 when the loss is being claimed. That's what the provision says. Now, this became a big problem for startups, particularly because startups, initially you raise angel funding and then you go to venture capitalists. So there is a lot of dilution that happens in the shareholding as you go through the growth process. So in many cases, it wasn't possible for the same shareholders, and then you have ESOPs, and then you have other forms of dilution. So by the end of 7th year, when you're claiming a loss in the first year, I think it was quite difficult for startups to meet this test and say that 51% of the shareholders were the same. So, to that extent, there is a relaxation saying that so long as any of the original shareholders are still there in the company when the loss is being claimed, they don't have to be 51% shareholders. Even if they hold just one share, as long as they are shareholders, you should be able to claim the loss. One limitation, though, is that you will have to do it. I mean, the loss has to be incurred within that 10-year period where you are still considered a startup, because after the 10-year period from incorporation you are not a startup anymore. So whatever, if you haven't incurred it, whatever you're incurring in the 11th year as a loss, you cannot take the benefit of this at any point in time later in the year. Yeah, so I think that's where the loss provisions stand currently.
Thank you. Thank you for really walking us through the exact provisions and how the exemptions are particularly carved out for startups. I think another tax exemption that startups themselves hear a lot about from founders, especially at the early stage of their growth journey, is about the angel tax provision. I think there has been a lot of chatter about it in the last 1 year, given that there were some tweaks announced in the finance budget of 2023. Perhaps you'd like to also walk us all through what the provision is, how does it impact startups, and how can is there any particular way that DPIIT recognized startups are given any exemption here?
Sure. So I think just to understand angel tax a little bit, right? I think angel tax was a provision that was brought in to target black money actually originally. So a lot of the startup valuations is more of an art than a science. I mean, it's a founder sitting across the table with a funder saying, okay, it's 3x, it's 10x, it's whatever that is. So that was probably misused by some people to pump black money into companies and convert it into white, and which is why the angel tax provision was introduced, saying that if there is a huge difference, if there is a huge share premium, right, if somebody is investing at a much higher valuation than what the book value or the discounted cash flow value of a company is today, then that premium will be taxed at 30% or 20, whatever the rate is, right? That's usually 30% at those levels. So that's really is what the angel tax. Now, obviously, while this is targeted at um, black money sort of situations, and I don't think the intent was to impact legitimate businesses. And if you have undergone the rigorous process of obtaining a registration from the interministerial committee, and as a registered startup, it was seen fit that you should be kind of exempted from this sort of requirements to some extent. Initially, the provisions were targeting small startups, so there were some conditions and limitations. And this kind of reminds me another point, which maybe I should have covered earlier, which is that when you are applying for the original your application as a startup, right, before the interministerial committee, which enables you to claim a tax exemption for the 10-year window. You get a 3-year tax holiday, right? I think there is a little bit of difference between the requirements for how, on what basis you get registered as a startup, and on what basis you get the tax exemption. And the turnover thresholds sometimes are a little different. So, and it has changed over the period of time as well. So, for example, you could get registered as a startup with DPIIT if your turnover is 100 crores. It has to be less than 100 crores. Whereas for the angel tax benefit and for this 80 IA benefit, sorry, for the 10-year, the 3-year tax holiday benefit within a 10-year window, even there now they have increased it recently to 100 crores, at least as far as the 3-year tax holiday is concerned. But for angel tax, it's only 25 crores. So, for example, for you to the notification which says that angel tax will not apply to you only refers to a 25 crore turnover threshold. So startups above that will not be protected under that notification. Second thing is, how is this 25 crore calculated? It is post money valuation. So it is the value of the entity after any infusion by the potential investor that we are looking at. But there are certain things that are excluded from this. So if we are seeing investments by non-residents, investments by venture capital funds, or investments by any listed companies, large listed companies whose net worth is more than 100 crore or turnover is more than 250 crore. So these kind of investments will get excluded when you are calculating the 25 crore limit. All other investments will be counted. Recently, in the last budget, this provision was expanded to cover investments by foreign entities as well. So historically, this was targeted only at domestic investors or investments from domestic investors. In this budget, 2024, 2023, it was expanded to cover foreign investors as well. Pursuant to that, certain notifications were not amended, which basically meant that the protection for even up to 25 crores from angel tax was only with respect to domestic investments and not with respect to foreign investments. So subsequently in October, the CBDT issued an instruction to the tax department saying that if there is a foreign investor that is coming in and you are saying angel tax is the only issue that you are investigating with respect to a startup, then you will just take the explanation of the startup and you will not challenge that explanation any further. So that is another form in which the department is trying to protect the startups from any sort of high-handed efforts for recovering money or whatever investigations from the tax department. So basically, up to 25 crores, if there is this kind of investments, you are kind of protected from angel tax if your investment is up to that level.
Right. I think we've received a question, and there is some doubts that the room has about really how does the provision work for a DPIT recognized startups. Perhaps you'd like to walk us through with a small example of exactly how the 25 crore is calculated and what really does the fair market, the premium, what does it mean, and what is the actual exemption that startups get here.
Sure.
Perhaps an example would be helpful to explain it to the room.
Sure. So let's say that the company is, today has two investors who have put in 100 rupees each, right? So your total share capital is 100 rupees. So that is what you will be testing against the 25 crore limit. Are you a startup which has less than 25 crore share capital to qualify for this exemption from angel tax, right? Now you are trying to look to raise money from other investors, and let's say 20 crores is coming from domestic investors and 10 crores are coming from 5 crores is coming from a venture capital fund and 5 crores is coming from a non-resident investor. So at the time when you are looking at whether angel tax applies or not, the question is, do I have a share capital of 25 crore? Now, this today my share capital is 200 rupees, right? All this money has not come in. So, but the way to look at this is it will be post money valuation. Post money, my valuation will be 30 crore 200, because it will be 20 crores from domestic investors, 5 crore from venture capital fund, and 5 crore from a non-resident. So 30 crores will post money will technically cross the 25 crore threshold, right? But I'm not supposed to include certain kinds of investments into this share capital calculation, which is the investment from the venture capital fund and the investment from the non-resident. Those are to be excluded for the purpose of this calculation. So which means if I exclude the 5 crore from the venture capital fund and I exclude the 5 crore from the non-resident, my total post money share capital today is 20 crore 200, which is below the 25 crore threshold. So I should be able to claim the angel tax exemption basis the current notification.
Perfect. I think that was extremely helpful for all of us to understand how does angel tax really work in the practical world. Maybe there are other exemptions that are also given to startups apart from the tax benefits. Is that something that you could briefly touch upon for the audience too?
Sure. So there are a few exemptions under the regulatory regime. So, for example, external commercial borrowing is a way for a startup to raise debt or loans from non-resident investors. And under FEMA, which is the Foreign Exchange Management Act, RBI has permitted certain relaxations. So, generally, when any company raises an external commercial borrowing, or which is basically a loan under this route, which could be in the form of a NCD or a pure play loan, the minimum maturity period sometimes ranges between 5 to 7 to 10 years, depending on what the end use is. So for example, if a company has to take money from a non-resident, has to take a loan from a non-resident and use it for, let's say, construction development or for working capital, this minimum maturity period means that that money cannot be given back to the lender before the 10-year period or 7-year period is up. Now, no lender normally wants to give such a long-term loan where their money is locked up for 10 years and the money cannot be given out at all. So then it becomes difficult to raise that kind of financing under that route. For startups, there is a two benefits under this route. One is that the minimum maturity period is only 3 years. So after 3 years, the funds can be returned at any point in time. And that becomes much easier for startups to raise money under this route, because 3 years is something that's okay. 3 to 5 years, I think generally lenders are okay with from a lending timeline perspective. Secondly, sometimes there is, startups do well, sometimes they don't do so well, and or they do very well as well. In either situations, I think the investor sometimes wants the right to convert the debt into equity, because if the company, sometimes we have seen situations where investors say, ideally I want the company to pay this money if possible. If not, then instead of writing it off, I'll convert it into equity and just hold it. This happens in social impact oriented enterprises, where money or return seeking is not the primary objective. It's about achieving social outcomes. There could be other situations where the investor is like, okay, I'm giving you debt now, but if the company does really well, then I want a portion of the upside. So I have the right to kind of do a convertible note and convert it into an equity thing, down the line in the future. So this is also permitted under the ECB route, where basically this is freely convertible. This debt can be freely converted without any prior permission or anything from RBI into equity by the startup. So these are two good sort of benefits that startups have. Secondly, under labor laws, there is a lot of requirements that you'll have to comply with. And without getting into the details, one large benefit is that for up to 5 years from the date of incorporation, the startup can self-certify and say that that they have complied with all of these requirements. So, and any sort of audit, etc., cannot happen unless there is a complaint, and that too after the first year of operations, etc. So that's another big benefit, where they don't have to worry about these sort of this numerous compliances under labor laws, and they can just focus on the business. Lastly, I think there is, in terms of obtaining patents or in terms of IBC resolution, insolvency, and procedures, they are eligible for the fast track procedures, which really reduces costs and increases turnaround times. So those are some of the benefits under the non-tax regimes that startups enjoy.
Thank you. I think you've mentioned two very important benefits that often get missed out on when we talk about the benefits offered to startups, especially the convertible note and external commercial borrowing. So, thank you so much for summarizing that and bringing that to the forth too. I think we've received a question on understanding exactly how can a startup access the tax holiday that is given to them. What is the process really? I know you touched upon briefly, but perhaps you could also, for the benefit of the audience here today, walk us through the exact procedure that startups need to follow in order to get the 3-year tax benefit.
Sure. So the startup has to first, I mean, this can be done online, and from what I understand, I think Startup India can also assist with the process of getting this single window sort of clearance. So I think so the application is made to the DPIIT, the interministerial committee sits on it, and if you meet the criteria, you go through the online process, you fill the forms, you upload the requisite documents, and you get the registration basis. That it is a prerequisite for claiming the tax benefit under the income tax uh, act as well, because the notification does refer to the fact that you need to have this as a certification from the DPIIT as well. So that's sort of how it works. um, yeah, I don't think I have anything else specifically on the process.
Right. Perhaps the audience here today would also like to refer to the notification that Startup India has, the 19th February 2019 notification, where a startup is defined, and that also mentions exactly what is the process that startups can follow to get the eligible certification to make them eligible to get the benefit. Another question that we are getting is uh, since you had mentioned the old tax regime and the new tax regime, I think the audience would also like to understand which particular tax regime should they be going for. And I think this has become like a holy grail question which we've been asking for many years now. But as a startup, would you have any opinion on which tax regime they should be going on?
Yeah, I think it's a good question. I think it's also maybe fairly case specific. I think the thing is, you have two choices, and I think you'll have to understand the consequences of either choice and then see what fits better. So, for example, the 22% new tax regime was envisaged as a easier regime to comply with. It's yes, you don't get the deductions. Yes, you may not get the it may not be the most tax beneficial regime if you look at it just from a purely numbers point of view, because if you're able to claim the losses and if you're able to claim the 3-year tax holiday, and even if you pay MAT at 15%, it's still lesser than the 22% that you claim here. But the thing is that this 22% is, again, you could claim, you can't claim too many. There are many limited deductions that you can take, then this 3-year tax holiday is not part of it. But there are other business expenses and deductions which is still possible for you to claim under the 22% new tax regime. So it was meant to be a simpler regime, and less litigious, less subject to scrutiny, less subject to sort of being questioned by tax authorities, and it's think of it as a cost for more tax certainty, right? Or the other way is, we can claim the 3-year tax holiday and any other benefits that that's under the other regime. And as the company grows, the challenge is that the questions could be raised by the tax department when the numbers start getting sizable, even if initially you are under the radar. So that's just a I think founders should understand the consequences on both regimes and see what suits their requirements. Some have more risk profile and appetite, some are not as much, probably more conservative, want a more simpler regime. Say I'll pay 7% extra if that means that buys me the piece from the tax department, because many times you don't have the funding, let's say even the year 5 or year 7, to be pursuing or responding to multiple tax audits or requests on any claims that you may have made under any of these exemptions and stuff.
Right, right. Thank you for that. I think we can now switch gears to the other bucket that we wanted to cover today, particularly corporate governance, and really understand from you, since you've been a part of so many transactions for big companies as well as small growing companies. How have you seen corporate governance play out for startups, and where have you think it really has become important for our growing startups to focus on corporate governance?
Yeah, so I think corporate governance is a sometimes overused word and jargon, but also I feel it's not taken as seriously as it should as well. And I understand. I mean, founders who are running startups are thinking more about the day-to-day operations, scaling. They have tons of other things on their mind, raising funds, cash flow management, and looking after a business. So I'm sure, I think corporate governance feels like a far off priority, or may not seem as important at that stage. But there are I think it's very important to keep this in mind from day one, at least at the back of the mind, and understand what sort of trade-offs that are happening when founders are taking decisions in the way they run the company. And there are a couple of points and examples that I wanted to kind of touch upon, based on both my experience and what we know in the public experience is already out there in the news as well. So simple things like, starts off with the building a culture of compliance, right? You have to take your compliances seriously, and if you're not doing the compliances on time or properly, cutting corners always has costs. And sometimes without the proper advice, these become unsolvable or much bigger problems later down the line, right? So one common thing that I have seen is sometimes the accounting and the financial management, the reporting is not as strong as it should be. People just transfer funds from one account to another account, or undertake transactions, put in personal money, take withdrawings from the company, and then at the end of the year, then it becomes a discussion with the CA, or as to, okay, how are we explaining this, right? These are all prone to being questioned, and this creates multiple problems later down the line. And I'll give you a few examples. So for example, when a company, right, there are two paths for a startup. They will always be looking for investors, eventually go up the chain and do an exit at a good valuation, or do an IPO. Now, both of these, whenever you go out and raising money, a due diligence is conducted, or you are putting a lot of information in the public domain if you're going to do an IPO. So at every stage, you are going to get increasingly more and more scrutinized. I'm not even getting into the how the tax regulators, or how the government and other regulators are going to look at it, and how you explain to them. This is just on the commercial side. The kind of scrutiny that's going to come in from the investors is something that we should be ready to explain and handle. And the problem is, if your compliances are not there, right, then you incur penalties. You'll have to pay interest. The penalty could be 100% of the tax amount involved, for example. Sometimes you can't access funding. Let's say you want to go raise money on the social stock exchange, right? You have to actually file your returns at the time every year. If not, you're not eligible to go in to the platform and even apply for or raise funding through that platform. So all of this becomes significant problems. Thirdly, even in terms of simple things like claiming losses, right? There is a lot of rulings today, because many people don't claim losses in their first return. and they file revised returns later because they realize, hey, okay, but this is a loss or whatever, right? And then there are divergent rulings on whether in that case you can claim that loss or not, because there are limitation periods and there's a way the provision is worded. So the best thing to do, the safest thing to do, is to make sure your losses are claimed in the first return that you file. Very, very simple, basic things like this will help in the long run, because otherwise you are losing out on that whole tax advantage or the benefit that you get from carrying forward all of that. Thirdly, sometimes um, from a regulatory perspective, sometimes these problems become completely unsolvable. So, for example, if you've let's say you've done something on the governance side, you have not done something the right way, right? Maybe with tax, it's like 1% penalty every month, so that's 12% interest a year, 12 to 18% interest, and 100% of the tax amount could be the penalty. So not only will you have to pay taxes at a later stage, you're paying 100% of that amount, plus the interest clock just keeps ticking all the time, right? So, and the look back period is 11 years for many sort of reassessment matters. So tax authorities can look back 11 years in the past and question what you have done, which is a very long period, and your liability keeps accumulating during that period of time. Secondly, under FEMA, for example, if you have done anything cross-border, if you go to compounding to RBI at a later stage, you have to pay 3 times the amount involved in that infraction, in that mistake that you have made. And on top of it, the RBI may ask you to unwind the structure. So a lot of times, people have tried to set up startups outside of India. They've tried to flip entities outside into Singapore or other places, and they didn't, they did it through a gifting structure or through a way which was not the right way. And then all of that had to be unwound, which becomes very problematic at a later stage in time. Thirdly, um, some examples of good governance, I mean, where governance has made a difference. I know the FTX crash has been, widely spoken about globally. If you actually see, FTX crashed globally, but FTX Japan survived because of the good governance practices that was actually followed there. And similarly, what we have seen in our experiences, initially startups, because of the the size of the startup and possibly non-availability of funds and correct advisors at that stage, they take certain calls which creates exposures, and this results in one of two things. One is due diligence happens, mostly hopefully these are solvable problems. If you have to put that penalty, interest, and the tax payment comes up in the DD report, this becomes a price adjustment when the purchase happens. So if the company is worth 1,000 rupees, and if the tax is 100 rupees, penalty is another 100, and interest is another 150, so the 350 rupees will become a price adjustment where the investor will only pay 650 rupees. They'll not pay 1,000 for the company. So your value is actually going down because of these kind of things, and this is something which can be fixed if you did it right the first time. The second problem that comes up is that you take a it becomes a kind of a reputational issue sometimes as well. So if you are a startup, and we've seen some companies that have become unicorns, right? They have taken these kind of positions for whatever reason, and suddenly you have to clean up the company, pay up all of this before you go and raise another round of funding. And that becomes could be a reputational issue in terms of fundraising, and that's why investors look for good governance. If the company is governed well, if the compliances are done in order, if shortcuts are not there, right, it gives a lot more confidence to the investor, and you are likely to get better value for your investment and your efforts at the time of exit. So even when, and sometimes if you are taking certain calls that okay, these are certain things which we are knowingly taking a call that okay, we are not going to do this now or take an aggressive position or whatever, you should still do it fully knowing what the consequences could be. What comes back to harm the company or the founder at a later stage is the calls that are taken without realizing what the total implications of that choice could be in the future. So I'm just going to pause there on the governance side.
Thank you so much for the detailed explanation of what a startup really should be looking at from doing from the corporate governance point of view. I think one question which we have received is what can founders really be doing And to add to that, my question would also be, what is the organizational behavior that must be there towards corporate governance, and break down the jargon of corporate governance as the term, and really what is the perhaps two to three things that a startup should do from the very first day that can help them in their scaling journey.
Yeah, I think two, three things is one is, see, wow, I think the culture or the attitude towards governance stems from the top, right? If the founders think it's important, then your staff, your your employees, your compliance teams will take it seriously. If cutting corners is the norm, right? If the attitude is okay, why should I do this, right? And I can tell you there are startups where we have given good advice and yet decision making has been skewed and has been different, right? And so that's not even lack of good advice or advisors, it's just that uh, why should you do it, why is this necessary, right? I think that's the sort of thinking sometimes that's there. And as I said, that has its own cost that is ultimately discovered. If not, you may not feel the pinch in the first 1 year, 3 years, or 5 years. Eventually somewhere, as I said, for tax it's 11-year look back period. For FEMA there is no limitation. So ultimately these choices have affected people, and what ends up happening is you end up paying 3 times, 4 times and more money to advisors to solve the problem at a later date, which could have been fixed in a much simpler way if you had done that the right way in the beginning. So I would say uh, set the right culture and the right tone. Your thinking and decision making should be right. But the second thing is, of course, um, while it is good to, in an ideal world, I understand the practical realities that you would want to fill every form, everything, and do it right. Something or the other is bound to get missed because you are. But the idea should be to make sure that you are investing in the right set of advisors, right set of internal capacity on the compliance side, right? Have a good CA, have a good company secretary, have a good person as an advisor who can support your CA and the CS, right, on when required. And you have to manage cost and quality for doing this. But if you have them on board, I think you will find that the lot of the regular routine compliances, etc., and all are clean and are getting done the right way, and that itself will reduce a lot of these pain points going forward in the future. And where there is a decision making that has to happen, I think from a founder's perspective, what are you trying to do, right? You are trying to make sure that the company is fairly compliant, that you are avoiding any of the large missteps or any red flag issues or any problems that, because you cut a corner today, it becomes so big that it destroys value in the business, right? Anything less than that, sometimes yes, you may face funding crunches, there may be other priorities, so you may have to take a business call on certain things. But always the perspective is to get these 2 3 people in the room and understand, is that going to be that sort of a problem or not? And if that is the case, then don't go down that path. And that's where sometimes I feel companies are still making mistakes, where they make these really large mistakes, which then, like, 2 years later, then when startups approach us and say, how do we fix this, and we're like, this is much simpler if we had just done this in the first place. So I think somewhere there is, I don't know, maybe as a lawyer, it's just a personal feeling, but you should be taking legal advice not once you're in a problem. You should be taking legal advice way before you are in a problem, so that you don't get into the problem in the first place. So that's when the advice is far more valuable than once you're already there. And see, once you're in a problem, then we charge hefty fees, right, to solve it for you, which shouldn't be the case. You can get much clearer, simpler advice for you to follow if you just uh, try to do it at the beginning and not focus on the business, but also keep governance and legal compliance as one of the key things that you need to be looking out for as you go down this journey.
Thank you. I think this is a great note for us to end the chat today. And we are also at time. So I guess we've done a good job of managing our time and also giving lots of answers to hot burning questions that startups always have. I think I'll echo the sentiment that we have noticing across all our social media where we are live. Thank you so much, Meyyappan, for giving us your time today. You've really walked us through holistically about every benefit that startups can maximize themselves on, and you've given them detailed explanations sometimes even with examples to really explain what the provision is. I think the way you've broken down the legal jargon and demystified the law for everybody is helpful, and this is one AMA that we like to keep for the record always. Thank you so much for spending your time today, and happy National Startup Day to all of us here today.
Thank you so much, Ragini. Thanks everyone for having me here. Pleasure. Have a nice day.
Thanks so much. Thank you.